Let's open this conversation up and talk a little bit more about what's happening to the economy. Joining us for that is John Ryding. He is Chief Economic Advisor at Brean Capital. And, John, I know you've written about this, too. Your point is the big difference between these two is that the banks are in much better position this time around, and they've been able to still keep loaning. How does that change the structure and the feel of this downturn?
Well, it stopped what in this case was a medical crisis that halted the economy from spilling over into a big financial crisis. We got those very violent moves down in the market in March, but we've rebounded since then because, as Steve said, the responses have been more forceful and more aggressive, both on the monetary and fiscal side. But we have to understand the constraints to a full recovery. The constraints in 2009 was the financial system, the impairment of the financial system. The constraints in 2020 is the virus spread. And as people have been reporting in a number of states, that virus spread is rising fairly rapidly right now. So we have to overcome not only governments being able to reopen the economy, but we have to overcome people's reluctance to be closely connected physically. And that, of course, hits a lot of industries negatively. Transportation, air transportation, vacations, restaurants, bars. Yes, they're coming back. And what your previous guest, Kevin, said was, to me, quite optimistic in terms of how businesses are adjusting to that. But the constraint for a full recovery here is a medical constraint. And we really need a vaccine to get us back to full employment and to whittle down what will be those last few percentage points of unemployment relating to those industries.
Hey, John, one thing I've thought about a lot is the extreme measures that we thought the Fed and the government were taking back in 2008, 2009 to try and address what was happening then. But this time around, we're looking at the Fed, I think, spending twice as much in terms of their balance sheet, ramping things up, maybe even more, and the federal government already spending 3 times as much in federal stimulus. We worried all the time back in 2010, 2011, what the blowback was going to be from all the spending and the big fat Fed balance sheet at that point. We never really saw anything that played out in terms of a big crash that you might have anticipated. What do you worry about this time around?
Well, let's think of the lessons of that. And again, Steve alluded to some of it. The Fed took a very, very long time to begin renormalizing rates. We're going to be in a zero-rate environment like last time for a long time. The Fed really never made much progress in reducing its balance sheet, so we're going to have an even larger balance sheet for a longer period of time this time. Now, I think there are 2 potential consequences. The first is inflation. And we could see some pickup in inflation down the road because our supply curves have been hurt. The supply chain's been hurt. And in a number of industries right now, we're feeling the effects of lower prices in industries where people don't want to be. But people have income to spend. The savings rate was at a record 33% because they couldn't spend in April. So that's one. And the other, I think, is we have the ongoing fragility of the financial system. It turns out the financial system is fine as long as it has Fed support. But these low rates and large balance sheets encourage a buildup in leverage. And that buildup in leverage manifested itself with problems in the financial system in February, going into March this year, and started the Fed having to take steps to help out the Treasury market even before we got into the couple of weeks before we got into the lockdown.